Wall Street is putting real-world assets on the blockchain. Treasury funds, money market funds, private credit, stocks, and eventually, even real estate. And here's the part most crypto investors are missing. This isn't just another crypto narrative. Some of the biggest names in traditional finance are already building the infrastructure. BlackRock, Franklin Templeton, JP Morgan, BNY, and dozens of other institutions are exploring tokenization. The market is still relatively small compared with traditional finance, but that's exactly what makes this story interesting. Because if even a tiny fraction of global financial assets moves on-chain, the opportunity could be enormous. Welcome to BlockAlpha. We decode crypto. We don't chase hype. Today, we're breaking down what real-world assets actually are, why financial institutions are interested, what is already happening in 2026, and what retail investors need to understand before jumping into the next big crypto narrative. Let's start with the simplest possible definition. RWA stands for real-world assets. The concept is straightforward. Take something that exists in the traditional financial system, such as a U.S. Treasury fund, a corporate bond, a money market fund, private credit, a stock, or even a property, and represent the ownership or economic rights to that asset using blockchain technology. The blockchain becomes part of the infrastructure used to issue, transfer, record, or manage the asset. And this matters because traditional financial markets were not designed to operate like the internet. Markets close. Settlement can take time. Different institutions maintain different databases. Transfers often require intermediaries. And access can depend heavily on geography, regulation, and minimum investment requirements. Blockchain technology offers a different model. A token can move on a blockchain at any time. Ownership records can be updated on-chain. Smart contracts can automate certain processes. And financial assets can potentially interact with other blockchain applications. But here's an important distinction. Tokenization does not magically turn a house, a bond, or a stock into a cryptocurrency. The legal rights still matter. The underlying asset still matters. Custody still matters. Regulation still matters. In many RWA structures, the blockchain represents an interest in an asset that remains legally connected to an off-chain entity, custodian, fund, or other structure. So the token is only one part of the system. And that's where things get interesting. Because institutions are already experimenting with this model. Take BlackRock. Its BUIDL fund was launched as a tokenized fund investing in assets such as U.S. Treasury bills and cash. The fund uses blockchain technology to represent fund interests and enable on-chain transfers under its applicable restrictions. This isn't a meme coin. It isn't a speculative token created overnight. It's a traditional financial product using blockchain infrastructure. Franklin Templeton is another major example. Its Franklin On-Chain U.S. Government Money Fund, represented by the Benji token, has been operating since 2021. Franklin Templeton says Benji was the first U.S. registered mutual fund to use a public blockchain as its official system of record. By April 2026, the Benji suite represented about $1.98 billion in assets under management. The fund has also introduced features such as peer-to-peer transfers and on-chain distribution of yield. That's a very different picture from the old idea that blockchain is only useful for buying and selling cryptocurrencies. The institutions are testing something much bigger. They're testing whether blockchain can become financial infrastructure. And that brings us to the first major reason Wall Street is interested: speed. Traditional financial markets rely on multiple layers of infrastructure. A transaction can involve brokers, custodians, clearing systems, settlement systems, banks, and other intermediaries. Tokenized assets could potentially simplify parts of this process. Instead of relying entirely on separate databases and reconciliation systems, Some information can be recorded and transferred on a shared blockchain infrastructure. The second reason is accessibility. Imagine a financial asset that traditionally required a large minimum investment or complicated access. Tokenization can potentially allow that asset to be represented digitally and divided into smaller interests. But there's a major warning here. Tokenization does not automatically mean that every person in the world can legally buy every tokenized asset. Regulation still determines who can participate. Some products are restricted to qualified investors. Some require identity verification. Some have geographic limitations. So when you hear someone say, anyone can buy tokenized treasuries from anywhere in the world, be careful. The technology may allow global transfer. The law may not. The third reason institutions are interested is programmability. A blockchain isn't simply a database. It can also run software. That means certain financial processes can potentially be automated through smart contracts. Payments, transfers, collateral management, redemptions, and interactions with other digital financial applications. This creates a possibility that traditional financial assets could eventually become programmable components of a much larger financial system. And this is where RWA starts connecting with decentralized finance. Imagine a tokenized treasury fund being used as collateral, or a tokenized asset being integrated into a lending protocol, or a stablecoin being used to settle a transaction involving a tokenized security. Instead of separate financial systems, you begin getting financial assets that can interact through shared digital infrastructure. But there is another piece of this story that we cannot ignore. Regulation. In the United States, the Genius Act became law in July 2025 and established a federal framework for payment stablecoins. It does not create a blanket legal framework for every tokenized real-world asset. That's an important distinction. But it does provide a major piece of regulatory infrastructure for stablecoins, which can become an important settlement layer for digital financial markets. In Europe, MiCA provides a harmonized regulatory framework for crypto assets and related services. Again, MiCA does not simply make every tokenized security legal, but it is another example of governments building formal rules around digital assets. And institutions love something that retail investors often underestimate: clarity. Large financial institutions don't want to build billion-dollar businesses around regulatory guesswork. They need rules. They need compliance systems. They need custody. They need legal certainty. They need operational infrastructure. And as those pieces develop, tokenization becomes much more realistic. But here's where retail investors often make a huge mistake. They hear the words, RWA is the future. Then they immediately search for an RWA token to buy. That's not investing. That's narrative chasing. A token can be associated with a powerful trend and still be a terrible investment. The real questions are much harder. What exactly does the token represent? Who legally owns the underlying asset? Who controls custody? How are redemptions handled? Who are the actual users? How much liquidity exists? What are the fees? What happens if the issuer fails? And perhaps most importantly, does the token actually capture economic value from the growth of the network? Because here's the uncomfortable truth. A successful technology does not automatically mean that every token connected to that technology will increase in value. The internet transformed the world. That didn't make every internet stock a winner. The same principle applies to crypto. RWA could become one of the most important blockchain applications of the next decade, and some RWA tokens could still fail. There's another misconception we need to destroy. Tokenization does not automatically create liquidity. Putting an asset on a blockchain doesn't guarantee that someone will want to buy it. A token can technically trade 24 hours a day while having very little actual trading activity. That's why serious investors need to distinguish between tokenization and liquidity. They are not the same thing. The current market data makes this clear. RWA XYZ currently tracks roughly $36.8 billion of distributed tokenized real-world assets, excluding stablecoins from that figure. At the same time, stablecoins are approaching $300 billion in total value. That tells us two things. First, the tokenization market is real. Second, we are still very early compared with the size of traditional financial markets. And that is exactly why institutions are paying attention. The potential market is enormous. Global bonds, equities, private credit, real estate, commodities, funds, treasuries. The question isn't whether everything will eventually move on-chain. Nobody knows that. The real question is, which assets benefit enough from tokenization to justify the transition? That is the battle happening right now. Some assets need faster settlement. Some need better distribution. Some benefit from fractional ownership. Others may gain very little from being tokenized. So what should retail investors do? First, don't chase the narrative. Learn the infrastructure. Understand the difference between a tokenized asset and a crypto token. Second, watch the institutions. Look at what major asset managers, banks, custodians, and financial infrastructure companies are actually building. Actions are more informative than marketing. Third, watch regulation. Because tokenization is not just a technology story. It is a legal story, a financial market story, and a geopolitical story. And finally, manage your risk. You don't need to put most of your portfolio into an RWA token just because the narrative is popular. The goal isn't to predict the next pump. The goal is to survive long enough to participate in the next major financial transition. RWA may not be the loudest narrative in crypto. It doesn't have the same excitement as meme coins. It doesn't produce the same headlines as Bitcoin price targets. But something very important is happening underneath the surface. Traditional financial assets are beginning to interact with blockchain infrastructure. And the companies building that infrastructure are not anonymous crypto startups anymore. They're some of the biggest names in global finance. That doesn't mean every RWA project will succeed. It doesn't mean tokenization will replace traditional markets overnight. And it definitely doesn't mean every RWA token is a good investment. But it does mean one thing. The experiment is no longer theoretical. Wall Street is testing blockchain as financial infrastructure. And if that experiment succeeds, the biggest impact of crypto may not come from replacing Wall Street. It may come from rebuilding parts of Wall Street on-chain. That's the real RWA story. If you want us to break down the most important RWA projects and infrastructure companies to watch in 2026, comment RWA below and subscribe to BlockAlpha. We decode crypto. We don't chase hype. I'll see you in the next video.